Danger next week. Ghost Week begins tomorrow, Saturday, December 27th, 2025, and ends when markets return to a normal rhythm after the year-end holiday period. The key point? Ghost Week isn't an event. It's a market condition. Thin liquidity, plus holiday scheduling, plus year-end books. In that condition, the most dangerous thing isn't news. The most dangerous thing is that a normal order can produce an abnormal candle. This video answers 3 questions. 1, what Ghost Week is in data terms. 2, why silver is prone to stair-step moves. 3, whether an $8 gap up in January is plausible, and what conditions would have to exist for that to happen. First, set the backdrop. Late 2025 saw a year-end rally in gold and silver, with silver up about 139% in 2025, alongside warnings about volatility because the market looked overbought and year-end liquidity was thin. Silver also pushed through fresh late December record levels, and year-end profit-taking can produce sharp, violent jolts. That's the soil Ghost Week grows in. When an asset has risen too fast, it only takes a modest thinning of liquidity for the slope of volatility to multiply. So what is Ghost Week in traditional market language? It's a hollow trading week around Christmas and New Year's, when volume, order book depth, and willingness to make markets all decline at the same time. You don't have to believe the slang. You just have to look at the calendar. Holiday closures and early closes create timing distortions, and those distortions often spill over into multiple asset classes. For silver futures specifically, the holiday trading schedule is public, and the New Year window, December 31st, 2025 to January 6th, 2026, is exactly the kind of period where normal rhythm gets chopped up. When the schedule is compressed, price doesn't stop. What happens is this. Price is forced to move through a narrower liquidity channel, so even a small shove can make price jump a step. Why silver in particular? Because silver is a smaller, less liquid market than gold, so it tends to amplify moves. And in 2025, silver wasn't just a monetary story. The drivers included investment demand, speculative momentum, a prolonged supply deficit, and industrial demand tied to AI data centers, solar, and EVs. Now add the politics, state, a layer that many videos exaggerate. Silver being framed as strategically important gives the narrative a security and supply chain skin. That doesn't make price jump on the spot, but it makes the strategic story stick to the metal. When a strategic story overlays a market that's already thin, people are willing to buy faster on breakouts. And Ghost Week is when breakouts most easily become stair-step jolts. But a serious investigation has to separate 2 things. Policy creates the story, liquidity shapes the candle. Now to the $8 gap up in January. It sounds specific, so we need to run it through mechanical constraints. There are price limit mechanics that matter. If silver is around $70 Oz, 7% is about 4.9 Oz. That means an 8 gap, roughly 11%, is usually not a one-shot jump inside a single overnight band. It would typically require A, multiple consecutive steps, or B, a sequence of sessions where the market reopens at a new valuation, or C, a volatility regime shift where the market moves in tiers. So for $8 to be plausible in January, at least one of 3 conditions usually has to be true. Price has already climbed to a higher zone before January begins, and then adds another large step. The market strings together a series of strong up sessions, not necessarily one single session. Extreme volatility forces a staircase path where each step is driven by hedging and leveraged positioning being pushed and pulled. This is where Ghost Week begins tomorrow actually matters. A hollow liquidity week is where the steps get laid down because it produces abnormal candles, forces some positions out, and then leaves a reconfigured structure for early January to inherit. Put simply, Ghost Week isn't when a trend ends. It's when the trend redistributes. Now to the mechanism that often gets mistaken for secret news, repricing after a holiday. During holidays, macro information still moves, geopolitics still moves, rate expectations still move, but staffing and participation are uneven. When narrative pressure continues while liquidity retreats, price can be pulled by one side more easily. When the market fills back in after the break, price may reopen on a different level. That's what people experience as a gap. And because silver is smaller, the gap effect can feel more violent than in gold. At this point, it has to be said plainly. 8 gap is a great number for a thumbnail, but it only becomes credible after you force it through the mechanical gates, price limits, holiday schedule, and liquidity. Now map next week by calendar logic. Tomorrow, December 27th, is Saturday. Futures won't behave like a normal session. Standard liquidity returns when the new week opens. The following week crosses into the New Year window with special holiday hours. Those transition periods usually create two kinds of danger. mean 1. Fake breakouts from thin books. 2. Snap reversals from profit taking and year-end squaring. That's why danger next week can be true, but true in the structural risk sense, not in the sense that a secret event is scheduled to happen. To avoid vagueness, anchor the year with 3 hard frames. Silver was up about 139% in 2025. The move was tied to investment demand and tight physical supply. ETF flows were massive, and year-end liquidity conditions increased the odds of extreme volatility. Those numbers mean one thing: the market was already hot. Ghost Week only needs to change the environment for the reaction to become violent. Now build 2 January scenarios to stress test the 8-tool claim. Scenario A: January opens with a macro repricing, weaker dollar, lower real yields, and silver climbs another few steps. Scenario B: January opens with year-end release valve, selling, after a 100% plus year, producing a sharp drop or whip before finding balance. Both scenarios share one thing: large volatility. They differ on direction. And Ghost Week is the phase that raises the probability of large volatility regardless of direction. Now to code Ghost Week in investigative terms. It's slang that legitimizes a feeling. But the feeling has a real backbone. Holiday liquidity effects recur, and when spreads widen, a move can look like a gap, even when the deeper truth is simply the order book vanished. So the most accurate message is Ghost Week doesn't force price up or down. Ghost Week reduces the reliability of signals. And when signal reliability drops, the market can trap both sides. Buyers get faked out, sellers get faked out. Now connect $8 gap to something testable: price limit mechanics. The correct question isn't, can $8 happen? It's, where does that $8 sit on the time axis? Overnight, a week, a sequence of sessions? Because one-shot 8 is often exaggerated without context. But if someone says, in January, then $8 can happen as a staircase. Week 1 up $3, $4. Week 2 up another 4. So the month looks like $8, even though no single moment was a clean 8 jump. That staircase is exactly what Ghost Week manufactures. It doesn't create the destination, it creates the bends. Finally, return to begins tomorrow. And what actually begins tomorrow is the phase where many desks have already reduced risk, many participants are out, and market depth is thinner. In that phase, 3 order types often produce ugly candles: year-end profit taking, rebalancing as the calendar flips, and hedging responses to rising volatility. And here is the core investigative point: you don't need a villain to explain a bad candle. You only need one condition: low liquidity. That's why titles like Danger next week are often right about the sensation and wrong about the cause. The cause is rarely conspiracy. The cause is structure. And this leads to the key. Why does January often gap more than other months? Because January is when markets reprice expectations after closing the books on the old year. And after a year like Silver 2025 and outs, Reuters shows strong silver ETF inflows and powerful investment momentum. And flows like that reverse, they rarely reverse smoothly, they snap. Now build a field test and for viewers to tell the difference between a real gap and a Ghost Week gap illusion. If price jumps, but futures volume doesn't rise accordingly, it's likely an order book thin illusion. If price jumps with a volume surge and the move extends across multiple sessions, it's more likely a genuine repricing, a gap created by a sequence. If price jumps and then gets yanked back quickly, that's a classic ghost move, a signal that breaks under thin liquidity. Back to the $8 number. Mechanically, $8 isn't impossible. But for it to happen cleanly, the market typically has to climb through multiple limit steps across multiple sessions. Or you need a macro chain strong enough to reset the valuation baseline. And because rate expectations and a weak dollar are major drivers, January will be highly sensitive to any signal about the path of interest rates. Zoom in. In thin liquidity weeks, markets tend to gravitate toward round numbers because that's where orders cluster. With price in the 70-plus zone, levels like 72.5, 75, and 80 become steps. Ghost Week makes it easier to touch those steps. But the same ease creates traps. Touch the step, then fall back on profit taking. Year-end profit taking is the symmetric counterforce. Here, more the investigative voice. Ghost Week is a word-of-mouth label for what professionals simply call liquidity risk. When year-end liquidity drops, spreads widen, and opportunity costs rise. Liquidity risk is what produces moves that later get described as manipulation. But the data often says something simpler. Fewer participants means price can be pulled farther, faster. Now, the second half begins with one question. If Ghost Week starts tomorrow, where is the biggest danger? Monday morning or the first week of January? The biggest danger usually isn't where everyone is watching. It's where the order book is thinnest, yet people still trade as if it's a normal day. And the New Year crossover has special trading hours, meaning there are windows that feel normal, but are actually running on holiday conditions. When holiday conditions overlay an overbought market, you get a recipe for large candles. Overbought plus thin liquidity plus profit taking. Now connect that to January. One thing makes January special after 2025. Price has traveled too far. When an asset rises roughly 139% in a year, any fund rebalancing can produce meaningful force because portfolio weights have drifted. If that force hits before liquidity fully normalizes after the holidays, it will feel like a gap. Now detox the $8 number. If silver is at 70, $8 is about 11.4%. That's not crazy for silver. This market is volatile and amplifies gold. But 11.4% almost never happens gently. It happens in steps, and it often comes with a symmetric drop somewhere along the path. So a responsible narrator has to say it. $8 is two-sided risk, not one-sided opportunity. Ghost Week increases two-sided risk because signals become less reliable. That's where price limits matter. The market has technical guardrails against runaway moves, but those guardrails can also make action look locked and then released in steps. This is why some people see limits and call it intervention. In reality, it's a public risk management mechanism. And this is why headlines like this sell. They mix three addictive ingredients. 1, a deadline, tomorrow next week. 2, a spooky label, ghost. 3, a shock number, 8. Investigation does the opposite. Drop the label, keep the mechanism. Drop the fake deadline, keep the real calendar. Drop the shock number unless it comes with conditions. The real calendar is simple. Holiday hours around Christmas, a New Year's market holiday, and special holiday schedules. The real mechanism is also simple. Thin year-end liquidity plus overbought conditions raise volatility. Price limits turn motion into steps. The condition for 8 is a multi-session staircase or a powerful macro repricing, not a you-haunted moment. Now, 2 on-the-scene sketches for next week. Scene 1, Monday opens, price pops as flows return. People call it a ghost week gap. Scene 2, after the pop, profit-taking drags price back, leaving a long upper wick. People call it a trap. Both fit a market where profit-taking and volatility risk coexist. The common denominator is that the market is running on an overbought base with thin liquidity. So a small push becomes a big move. One final political layer, only to keep perspective. Strategic framing doesn't predict price, but it can make silver feel like a strategic story. And strategic stories make people react more aggressively to breakouts. In a hollow liquidity week, aggressive reactions can become jolting candles. Now answer the headline directly. A ghost week begins tomorrow. Yes, if begins means the start of a period when signal reliability drops. Silver could gap up $8 in January? Possible. If gap means a stepped total move across several sessions or weeks, or major macro repricing, a one-shot $8 move must be checked against limit mechanics. Danger next week. Yes, because the real danger is thinking the market is speaking clearly when it's actually speaking in the voice of thin liquidity. Close with 4 testable claims, silver surged dramatically in 2025 and faces elevated volatility risk in year-end thin liquidity, overbought conditions. Silver is smaller than gold and tends to amplify moves. Some forecasts talk about higher levels later, but the path is jagged. Holiday hours and price limit mechanics create step-like behavior rather than smooth motion. Holiday liquidity decline is a recurring pattern that widens, spreads, and raises opportunity cost. If you hold those 4 claims, the headline can't drag you around. You'd all understand why Ghost Week can set up a January full of gaps, and why gaps are usually structural outcomes, not secret whispers. And the final investigative line is this: when the market is hollow, the market structure becomes the news. If January prints an $8, it won't come from the ghost story. It will come from a market stretched all year, and a hollow liquidity week is simply when a stretched string is most likely to sound loud. If you hear that sound, remember, price limits, the holiday schedule, and liquidity are the 3 bones under every candle. The episode ends here, right before the new week, because the biggest danger often arrives when the market gets crowded again, but still carries the thin structure of the holiday period. If the first session of the week explodes, it will explode in steps. If it breaks, it will break in steps. Both are fingerprints of the same ghost week condition. That's how a hollow week can shape an entire January. Not through news, but through how the market delivers liquidity. Final conclusion: Ghost Week doesn't predict direction. It only says that any direction can look more extreme than normal. And in silver, a market that rose 100% plus in a year, more extreme than normal tip can be enough to turn exaggeration into a real candle. In the next session, you only need one thing to test every rumor: the open, the depth of the book, and how liquidity responds. That's the whole story of danger next week. not as legend, but as mechanism. Now widen the frame. Ghost Week becomes a 2-week risk map. A hollow liquidity week doesn't to just print strange candles, it can create the path for January to open on a price level that feels off versus expectations. The reason is technical. When many desks scale down, the remaining liquidity is concentrated in fewer market makers, spreads widen, depth shrinks. The same order size produces bigger price impact. If you want to understand what the ghost really is, it is the empty space between price levels that have real liquidity. When price steps into that space, it moves fast, like falling down stairs. And that's the core issue. Year-end liquidity can amplify volatility, and profit-taking makes the resulting motion harder to read. By this point, we can bring the alert gap up in January back into the price limit mechanics. CME publishes a 7%, 13%, 20% limit framework by time window, with 7% often applying in certain overnight sessions. At roughly $70, 7% is about 4.99. That means an 8-move, 11% plus, typically requires multiple steps, not a single step, or it requires a sequence of sessions where the market reopens at a new valuation over time. And Ghost Week is the phase that most easily manufactures steps, because it pushes the market into a rhythm of step up, step down, step up, instead of a smooth line. This is where many people get it wrong. They treat a gap like a mysterious jump. In real structure, a gap is often the sum of multiple liquidity slips. And because silver is smaller than gold, Reuters emphasizes that silver tends to amplify gold, meaning those slips often come with larger amplitudes. Now, strip danger into 3 concrete dangers so it isn't vague. Danger 1, false signals, breakouts that occur in thin conditions, look like a new trend, but are really just a liquidity void. Danger 2, snap reversals. Year-end profit-taking hits exactly when buyers think the trend is being confirmed. Reuters explicitly flags profit-taking risk in year-end liquidity. Danger 3, stepwise limits. Price limits make moves look like lock, unlock, burst. Whipping crowd psychology. Put those 3 together and you understand why. Ghost Week is a fair label, not because of ghosts, but because the market stops speaking in its normal language. Now shift to January. Why does the market often reprice in January? Because January is when many portfolios reassess weights after a year of extreme moves. Reuters puts 2025 silver up around 139%. That's a massive weight distortion. When weights distort, early January rebalancing can produce large flows. In a deep market, those flows get absorbed. In a post-holiday market, they can print as a gap. But the gap up story is only half. The other half is gap down. If 2025 was a year where many chased because of a tight supply narrative, ETF flows, and industrial momentum, January is also when many lock profits because they fear a reversal. Reuters gives enough context for both directions. On one side, the perfect storm and industrial investment demand. On the other, overbought warnings and year-end liquidity. That's why danger should be read as 2-way volatility risk, not a 1-way opportunity. And if someone says 8 up, the correct investigative question is, does the 8 up come with a $5 down somewhere along the way? Because stepwise, markets rarely travel in one direction. Where does the step mechanism come from? Liquidity, price limits, and profit-taking structure year-end book closing behavior. Now return to politics, only to place it in the correct role. Silver is on the final 2025 critical minerals list, USGS DOI, and Reuters quotes Doug Burgum describing a data-driven roadmap that adds a strategic narrative layer to silver. That layer can make buyers more aggressive on breakouts, but it doesn't exempt silver from Ghost Week. It can do the opposite. Strategic narrative makes the crowd react faster, and fast reactions and thin liquidity print bigger candles. This is the mechanism. Investigative reporting leans on. Narrative determines how fast people hit the button. Market structure determines what shape that button press prints. So Ghost Week is a slope amplifier for stories that already exist. And in 2025, the story already exists. A historic surge, big ETF flows, and industrial momentum. Now here's a practical checklist for seeing Ghost Week without superstition. Checklist 1, holiday schedule, during trading hours. CME publishes the New Year window for 12/31/2025, 1/2/2026. Checklist 2, price limit mechanics. The 7%, 13%, 20% framework creates steps. Checklist 3, Reuters warning about year-end liquidity and profit taking. If all 3 are true in the same week, any gap story has structural logic. If one fails, for example, liquidity unexpectedly returns, Ghost Week loses most of its power. Bring it back to the numbers to keep it investigative. Reuters says silver rose about 139% in 2025. FT describes it as one of the strongest years in decades. Those numbers aren't bragging rights. They're proof the market is stretched. The more stretched the market, the more dangerous Ghost Week becomes, because a small liquidity slip can make a tight string sound loud. And that loud sound is what produces 8 gap stories. But investigation requires a distinction. A loud sound can be music, or it can be a string snapping. Reuters' overbought and reversal risk warnings mean the snap risk is real. So if January prints an $8, the question is that $8 the first step of a new leg, or the last step of an exhausted move? And the answer usually lives in one place. Does price hold the new level after liquidity normalizes? Add one more layer. Many people watch comics, but silver also has a huge OTC ecosystem. LBMA publishes monthly silver clearing statistics, reminding you the off-screen market still shapes systemic risk. When OTC clearing runs on a different holiday rhythm than exchange-traded derivatives, the feeling of dislocation and gaps becomes more common. That's not a claim of a secret event. It's a description of gears running out of sync during holiday periods. And that's what Ghost Week really means: non-synchronization. In non-synchronization, moves don't look smooth, and it's easy to misread them as signals. So the discipline during Ghost Week is trust the calendar and structure, not the shape of a single candle. Now a specific question the headline implies: does January mean the first week or the whole month? If it means the whole month, $8 is entirely plausible in silver because silver is more volatile and amplifies gold, as Reuters notes. If it means the first week, $8 is a very large move and would typically require a chain of macro conditions, plus extremely thin liquidity, plus strong crowd psychology. And because CME has stepwise limits, now large moves usually unfold across multiple steps or sessions. That matters because it changes the story, not one gap, but a staircase. Ghost Week builds staircases by making the steps deeper and slipperier. A geometric example. If silver goes from 70 to 78 in January, that could be 70, 73, leg 1, 73, 8, and 76, leg 2, 76, 78, leg 3, with pullbacks in between. Those pullbacks are where danger lives. They force leveraged traders out, turning them into forced sellers. When forced selling hits thin liquidity, price falls faster, creating the illusion that someone just did something. But the 2025 context Reuters provides is already enough to explain it. Volatility can be structural without requiring a conspiracy. That's the core of the episode. Ghost Week makes normal moves look abnormal. And in a year where silver rose, Bitcoin was 139%, the boundary between normal and abnormal is already thin. Return to the macro backdrop. Reuters.jsft highlight. Precious metals are supported by rate expectations and geopolitics. The background wind January will be sensitive to. If that wind stays favorable, Ghost Week may function as a run-up, and January opens a new staircase higher. If the wind turns, Ghost Week may be the shed before January stabilizes. Either way, the logic doesn't change. Thin liquidity makes every wind shift feel stronger. So the headline, danger, is right in one sense. It doesn't predict direction. It predicts steepness. The market can rise $8 in January. The market can also drop several dollars in a few days. Both are the same kind of danger: volatility. Now we bring back the AGAP ups 8s in January claim and put it against the price limit mechanics. CME publicly outlines price limits of 7% and 13% to under 20% by time window, with 7% often applying overnight in certain sessions. At around $70, 7% is roughly 4.9s. That means an $8 move, 11% plus, usually requires multiple steps, not a single step, or a sequence of sessions where the market reopens at a new valuation level over time. Ghost Week is the kind of period that makes steps more likely, because it pushes the market into a pattern of step up, step down, step up, rather than smooth continuation. This is where many people misunderstand the word gap. They treat it like a mysterious jump. But in real market structure, a gap is often the sum of several liquidity slippages. And because silver is smaller than gold, it tends to amplify gold's moves, meaning those liquidity slippages can be larger in magnitude. Now let S break danger into 3 concrete hazards so it doesn't stay vague. Danger number 1, false signals. A breakout happens in thin conditions. Looks like a new trend, but is really just a liquidity void. Danger 2, snapback reversals. Year-end profit-taking hits right when buyers think they re-ask, confirming the trend. Danger number 3, stepwise constraints. Price limits make the move feel like lock, release, burst, which whipsaws crowd psychology. If you combine these 3 hazards, you understand why Ghost Week is a reasonable label. Not because of ghosts, but because the market stops speaking its normal language. Now we move into January. Why does the market often reprice in January? Because January is when many portfolios reassess weights after a year of extreme moves. If silver is up roughly 139% in 2025, that's a massive allocation distortion. When weights are distorted, January rebalancing can create large flows. In a deep market, that flow gets absorbed. In a market still recovering from holiday-thin conditions, that same flow can create what feels like a gap. But the gap up scenario is only half the story. The other half is gap down. If 2025 is a year where many participants chase the narrative, tight supply, large ETF inflows, industrial demand, then January is also where many participants lock profits because they fear a reversal. That's why danger should be read as two-sided volatility, not a one-way opportunity. And if someone says $8 up, the correct investigative question is, does 8 up come with a $5 or 6 down somewhere along the path? Because a stepwise market rarely goes only one direction. Where does stepwise motion come from? From liquidity, from price limits, and from profit-taking close-out behavior. Now we put the political layer into its proper role. Silver being labeled a critical mineral adds a strategic narrative. That narrative can make buyers more aggressive on breakouts. But it doesn't exempt silver from Ghost Week. If anything, the strategic narrative makes the crowd react faster, and fast reactions in the thin liquidity produce bigger candles. That's the core dynamic. Narrative determines how quickly people press the buy button. Market structure determines what shape that button press produces. So Ghost Week is a slope amplifier for stories that already exist. And in 2025, the story already exists. Silver's extreme run, large investment flows, and industrial demand. Now here's a checklist to look at Ghost Week without superstition. Checklist. Number 1, holiday schedule and trading hours. Checklist 2, price limit mechanics that create steps. Checklist 3, late year warnings about thin liquidity and profit taking. If all three are true in the same week, any gap story has a structural logic underneath it. And if one of the three is not true, if liquidity suddenly thickens, Ghost Week loses most of its magic. Now we return to the numbers to keep the tone investigative. A roughly 139% year is not a bragging statistic. It's a reminder the market has been stretched tight. The tighter the stretch, the more dangerous Ghost Week becomes because a small liquidity slip can make the string snap loud. And that loud sound is what creates the viral Gap 8 narratives. But investigation requires a distinction. A loud sound can be music, or it can be a break. Overbought conditions and reversal risk mean break risk is real. So if January does print $8, the question becomes, is that $8 the beginning of a new repricing regime, or the final step of a blow-off move? And the answer usually sits here. Does the market hold the new level after liquidity normalizes? Now we add one more layer many people ignore. Silver is not only a US futures story. There is a huge OTC ecosystem as well. When OTC rhythms and exchange-traded derivatives rhythm drift out of sync during holidays, the feeling of dislocation and gap becomes easier to generate. This is not a claim of secret events. It's a description of gears running asynchronously during a holiday phase. And that is what Ghost Week really means: non-synchronization. When the system is out of sync, you see motion that isn't smooth, and you're tempted to call it signal. That's why the discipline during Ghost Week is trust the calendar and the structure, not the shape of a single candle. Now, a concrete question implied by the headline, does January mean the first week or the full month? If it's the full month, $8 is entirely plausible in silver because silver is more volatile than gold. If it's the first week, $8 is a very large move and would require a chain of macro conditions, extremely thin liquidity, and unusually strong crowd behavior. And because price limits create steps, a big move usually happens across multiple steps, sessions. This matters because it changes the storytelling. Not one mysterious gap, but a staircase. Ghost Week builds the staircase by making the steps deeper and the surface more slippery. Here's a simple geometric example. If silver goes from 70 to 78 in January, it could be 70, 73, step 1, 73 to 76, step 2, 76, 78, step 3, with pullbacks in between. Those pullbacks are where the danger lives. They force leverage users out, turning them into forced sellers. Forced selling in thin liquidity drops price faster, creating the illusion that someone just did something. But the year's structure is enough to explain it. Volatility comes from structure. You don't need a conspiracy assumption. That's the episode's core. Ghost Week makes normal moves look abnormal. And in a year where silver is up roughly 139%, the border between normal and abnormal is already thin. Now return to the macro backdrop. Precious metals are supported by rate expectations and geopolitical context. That's the background wind January will be sensitive to. If the wind stays favorable, Ghost Week can be a launch ramp and January opens into higher steps. If the wind shifts, Ghost Week can be the shakeout before January stabilizes. Either way, the logic doesn't change. Thin liquidity makes every wind shift hit harder. And that SY danger is correct in one specific sense. It doesn't deforecast direction, it forecasts steepness. The market can rise $8 in January. It can also drop several dollars in a few days. Both are the same kind of danger, volatility. Now we add the final anchor. If you want evidence that Ghost Week is a recurring structure, holiday liquidity compression is a repeating pattern that affects spreads and opportunity costs year after year. That's the dry description of what the thumbnail calls ghost. Once you accept the dry description, you stop being tempted by the haunted story. You look at every candle next week with one question. Is this a real regime change or just a liquidity void? That's the only discipline that keeps Ghost Week from swallowing you. And it is the only discipline that turns Gap 8 TAR into analysis instead of a scare line.